Looking for a great business that is perfectly positioned for today's geopolitical environment? Want a yield that beats the market and dividend growth that beats inflation? Like the idea of getting a high quality dividend growth stock on sale? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a major defense contractor. What do we know about human nature? Conflict is inevitable. It's been true since the dawn of human civilization, and it'll be true until the end of human civilization. Except now we're fighting with missiles instead of arrows. So you take an unlimited demand runway and add on top of it defense products that keep getting more complex and expensive. Plus, today's geopolitical environment is especially hot. That positions this major defense company very, very well. And that should translate to them being able to grow their revenue, profit, and dividend for many years to come. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Huntington Ingalls Industries Inc., which appear to be trading at a significant discount today. Huntington Ingalls Industries Inc., stock ticker HII, is a major American defense company operating as the largest independent military shipbuilder. Founded in 1886, Huntington Ingalls is now a $9 billion by market cap military mammoth that employs over 40,000 people. Huntington Ingalls primarily designs, constructs, maintains, and repairs a range of nuclear and non-nuclear ships. These ships include aircraft carriers, submarines, and amphibious assault ships. The United States Navy is by far their largest customer, comprising approximately 90% of the company's total annual revenue. The company operates across three segments: Newport News, 59% of fiscal year 2021 revenue, Ingalls, 27%, and Technical Solutions, 15%. Huntington Ingalls benefits and profits from human nature. Conflict is an element of human nature. It's part of our reality. And so sovereign defense will be necessary for as long as sovereign entities exist. Humans have demonstrated that we can't have one without the other. What makes Huntington Ingalls special as it relates to defense is that they're the only company that manufactures certain products for the US military. Nuclear-powered aircraft carriers are the primary example. If the US military orders a nuclear-powered aircraft carrier, Huntington Ingalls will be the company to build it. Adding yet another advantageous layer on top of all of that is the fact that defense products are steadily becoming more complex and expensive as time goes on. Projectiles, for instance, have gone from arrows to missiles. This technological evolution in defense provides a built-in escalator in terms of growth, and it further entrenches the established companies that command the scale and know-how necessary to manufacture the appropriate products for modern warfare. This positions the likes of Huntington Ingalls very well for continued growth in their revenue, profit, and dividend. To date, the company has increased its dividend for 10 consecutive years. That might seem like a short track record, however, it's actually as long as it possibly could be, as Huntington Ingalls was spun off from former parent company Northrop Grumman Corporation in 2011. So they've basically been increasing the dividend right from the outset. And the 5-year dividend growth rate of 17% shows what a fast start they're off to. Now, it wouldn't be realistic to expect that kind of growth to persist forever. Some of this initial explosive growth was possible, even inevitable, because the payout ratio started out at 0% upon the spinoff, giving the company the ability to quickly expand that number. That said, the payout ratio is still only 35.4%, even after aggressive dividend growth. This gives the company plenty of room for more dividend increases. You also get the stock's market-beating yield of 2.3% to start off with. That yield, by the way, is 50 basis points higher than its own 5-year average. Solid dividend numbers here right across the board. Looking at business growth, Huntington Ingalls advanced its revenue from $6.7 billion in fiscal year 2012 to $9.5 billion in fiscal year 2021. That's a compound annual growth rate of 4%. This is solid. I usually expect a mid-single-digit top-line growth rate from a fairly mature company like this, and despite being spun out into an independent entity only recently, it is mature. Meanwhile, earnings per share increased from $2.91 to $13.50 over this period, which is a compound annual growth rate of 18.6%. We can now see that the high dividend growth rate has been supported by like earnings growth, which is why the payout ratio remains somewhat low. The wide spread here between top-line growth and bottom-line growth can be largely explained by a combination of margin expansion and share buybacks. Net margin has more than doubled over the last 10 years, and the outstanding share count is down by approximately 20% over this period. Looking forward, CFRA believes that Huntington Ingalls will compound its earnings per share at an annual rate of 7% over the next 3 years. This would clearly be quite the growth slowdown relative to what the company generated over the last decade. This is less than half that of the company's proven earnings per share growth rate over the last decade. Is it totally unreasonable? Not necessarily. I say that because the company already expanded its margins considerably, giving them one less arrow in the quiver in terms of their ability to improve the business. To the contrary, CFRA notes that the possibility of margin compression due to fixed price contracts in an inflationary environment. Also, the company engages in very large-scale projects. Results can fluctuate over short periods of time depending on completion dates. On the other hand, we have to guard against underestimating this business. Keep in mind, Huntington Ingalls has a backlog of nearly $50 billion. That's more than 5 times the size of the company's entire market cap. Put another way, it's about 5 years worth of revenue. This company is not short on work. Moreover, the geopolitical conditions, including open war in Eastern Europe, are such that US defense spending will likely be even more prioritized than before. And it's not like defense spending is ever really a low priority. CFRA puts it like this, and I quote, "CFRA has found that US defense spending typically grows regardless of recessions, deficits, or political parties in power," unquote. In the end, I'd say that a high single-digit bottom-line growth rate, especially in this uncertain environment, would be nothing to scoff at. With the payout ratio still being low, this kind of earnings per share growth would easily give the company the capacity to grow the dividend at a high single-digit rate over the next few years. Pairing that with the 2.3% yield sets us up for a very nice combination of yield and growth. Moving over to the balance sheet, the company has a good financial position. The long-term debt-to-equity ratio is 1.2, while the interest coverage ratio is 8. These numbers are not bad at all on their own, but the long-term revenue visibility via the large backlog makes them even better to my eye. Said another way, I don't think a balance sheet needs to be pristine when you have multiple years of revenue already locked in. Profitability is strong, and it's only been getting stronger. Over the last 5 years, the firm has averaged annual net margin of 7.3% and annual return on equity of 35.7%. The margin expansion story has been remarkable. A decade ago, net margin was routinely running below 4% annually. This well-run defense company benefits from the current geopolitical climate with increasing complexity and costs across defense products only serving the business. And the company is protected by durable competitive advantages, including high barriers to entry, large economies of scale, technological know-how, R&D, IP, long-term contracts, switching costs, and a unique government relationship. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. An oligopoly among major U.S. defense companies limits competition. On the other hand, regulation is amplified through direct government oversight. The very business model has geopolitical risk, which can cut both ways. The current democratic regime in the U.S. government could aim to limit defense spending, which would impact defense companies. The company does have a sizable backlog to mitigate against this risk, and this spending tends to only grow over the long run. Customer concentration is a risk. The company is almost completely reliant on only the U.S. Navy. Highlighting this risk, CFRA states this, and I quote, "This concentration on Navy contracting subjects HII to the risk of government funding cuts for major ship programs. The Navy has proven a reliable long-term growth customer, though, and we see increasing bipartisan support for Navy superiority over non-democratic nations, mitigating funding risk." And I unquote. The large backlog introduces execution risk. The company must complete large, complex projects in a timely and cost-effective manner. These risks are worth reviewing and considering, but I do see the stock's reasonable valuation as overcoming these risks. The price-earnings ratio is sitting at 15.6. That is not high by any measure. Most major defense contractors are commanding earnings multiples of at least 18 right now. There's also the price-to-sales ratio of 0.9, which is slightly off of its own 5-year average of 1.1. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. Now, this is as high as I'll go with a long-term dividend growth rate expectation, but I don't see this as too much of a stretch for the business. It's well below their demonstrated growth across both earnings per share and the dividend over the last decade. The near-term earnings per share growth forecast is already nearly this high, and the low payout ratio would easily allow for the dividend to grow faster than earnings for the foreseeable future. Furthermore, their massive backlog practically guarantees prosperous years ahead. I view the 8% dividend growth rate as a very realistic target for the business. The dividend discount model analysis gives me a fair value of $254.88. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Huntington Ingalls as a 3-star stock with a fair value estimate of $223. CFRA rates Huntington Ingalls as a 3-star hold with a 12-month target price of $241. I came out the highest, but the range here is fairly narrow. Averaging the three numbers out gives us a final valuation of $239.63, which would indicate the stock is possibly 15% undervalued. Here's the bottom line, guys. Huntington Ingalls Industries, Inc. is a high-quality business operating within an oligopoly, benefiting from a favorable environment. Human nature gives them a nearly unlimited demand runway for products that keep getting more complex and expensive, and their main customer has extremely deep pockets, with a market-beating yield, double-digit long-term dividend growth, a low payout ratio, 10 consecutive years of dividend increases, and the potential that shares are 15% undervalued. This is a timely idea for long-term dividend growth investors looking to take advantage of the world's current affairs. And now for a special news announcement. The CEO of Chevron Corporation, stock ticker CVX, recently sat down for an interview with CNBC. In that interview, he stated that the oil market remains tight, which means the recent price decline may be short-lived. We highlighted in a video back in early June that Warren Buffett has been investing billions of dollars into oil companies, including Chevron. Chevron stock has been weak of late, and this correction could be an opportunity to join the Oracle of Omaha. Don't forget about Chevron. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.